Hey Rick.
Sorry, one sec. Hey, Sharon.
Hey there. So today we're going to cover some things about a. I just want to point to this little one on my shoulder. This is Symphony, and Symphony doesn't know that I'm kind of afraid of cats, and so she's
Hmm,
letting me know that she's not afraid of me. So she's not leaving me alone. So she's joining us for the video today. So
sounds
she
good.
can pop in and out
Oh,
of the
there she
video
is.
just like that.
Yeah,
Forgive these little blurps on the screen. But anyway, I want to talk to you today. I want you to talk about first-time home buyers. I mean, it's a massive number of people still buying for the first time, and a lot of people new to Canada as well, not even understanding our whole processes. And I love the first-time home buyer. There's so much to do to educate them, to help them learn what to watch for, what to buy, what not to buy. Walking on that journey with them is absolutely amazing, and I love it. So I want you to talk about um, all the good stuff that from the financing end for first-time home buyers specifically.
sounds great. Well, I actually wanted to discuss a government program that a lot of people do not take advantage of, and it's really an excellent program. It's been around for a long time. It's just called the Home Buyers Plan. You can find all the information about it on the government website if you just type it into Google. But the long and short of it is you can really get a big tax refund by contributing the money to your RSP. And
Right.
then you can, and here comes the Cheshire Cat again.
Yeah.
Uh, you can get a lot of a pretty sizable tax refund because you can put up to $35,000 for every person that is considered a first-time home buyer
Right.
buying the house
Yeah.
or condo or whatever.
Yeah.
Uh, can put up to $35,000 in their RSP, which, if you're in one of the higher tax brackets, that could be, as much as half, like 50 cents on the dollar that you put into your RSP, you could be
Yeah.
getting that back as a tax refund.
Right.
So if you can increase your down payment by well, if there's two of you, that could be like an additional $35,000 you've got towards your down payment simply by taking the money you might have already had and for your down payment and putting it into an RSP. Now,
Hmm.
there is a caveat that it has to be there for at least 90 days.
Yeah.
Uh, but it really is a great program to take advantage of. Now, you do have to pay it back. It's essentially a loan to yourself from yourself.
True.
You do have to pay it back, but you've got 15 years to do so. And if you don't make a payment that year, then it just gets added to your taxes that year. So, I mean, maybe if, down the road, uh, you're taking time off work for mat leave, you're unemployed or whatever, and your income's not particularly high that year, you just take a year off from making a repayment. The repayments start about 2 years after you've purchased the home, depending on the time of year that you buy the home. So really, you've got about 17 years to pay it all back to yourself,
That's right.
which then, of course, you can take it out of your RSP again at that point when you're reaching retirement age, right?
Yeah.
Uh, Ideally. But yeah, it can be a massive advantage because if you have a bigger down payment, if you can get into the territory of 20% down, you can avoid the CMHC premium altogether, which is again a significant amount of money. It's just a really good idea if you've got the time to take advantage of it. You can, if you already have the funds in your RSPs, this can be an additional area. You can access that money without having to take a big tax hit.
Yeah.
Because when you put the money in, you get the tax refund. When you take it out, if you do it under the first-time home buyers plan, you do not pay any taxes on those funds. That's the advantage of the program.
Yeah.
Uh, so now you have to qualify as a first-time home buyer,
Yeah.
but that's a bit of a misnomer because after I believe it's 4 or 5 years of having owned a home, you can be considered a first-time home buyer all over again. Now you can't owe any money on like previous uses of the plan,
Yeah.
but just because it's not the first time you're buying a house doesn't mean that you're not considered a first-time home buyer under the program. Uh, and you can also uh, do RSP loans in order to get money to put into the plan. And then, of course, when you get your tax refund, you can then turn around and take that money to pay down the loan significantly. Now, you have to be careful when we do this, if that's the route you take, because you have to watch out for the total debt service and gross debt service ratios. So, I would advise, giving me a call before you do that, so I can see what your TDS and GDS ratios would look like if you do decide to incur debt in order to make an RSP contribution.
Yeah.
So,
I think that's a good thing, though, anyway, to give you a call, because it's all a part of the financial planning aspect. And real estate and the mortgages go hand in hand, but so does the RSP, so does all of the other investments that we can take out, because the government's continually looking for ways. And I'm hoping down the road as well, we'll have some options as well from the government for further to help the first-time home buyer.
yeah, so as I mentioned, you have to have the money in for at least 90 days.
Yeah.
But, if buying a home is maybe a few years down the road, there's other advantages to having the money in your RSP, like it grows tax sheltered. So
Yeah.
if you have money sitting in investments that's not in a TFSA or an RSP, you're going to be paying tax on that, and that's going to slow the potential growth of the investment.
Yeah.
So you can put it into the RSP, and you're going to have more money at the end of the day because of not having to pay taxes, because the money that would otherwise go to the taxes will stay in the RSP and can grow that much faster. So it's a really advantageous program, and a lot of people aren't aware of it. RSPs often get a bad rap because, yes, you do have to pay taxes on it when you take it out normally, not under the first-time home buyer plan.
Right.
But the idea is you're deferring those taxes for years, and often, when you do take it out, hopefully you're going to be in a lower tax bracket than you are when you're working. Well, I shouldn't say hopefully, because hopefully you're still making a ton of money when you're retired, but for most
Right.
people, they'll be in a lower tax bracket.
Yeah, yeah. Now the other thing I also want to mention, just because you and I know it, but I know very quickly it went over, you get 15 years after that initial 2-year period. You get that 15-year period. So whatever you're taking out, you're only paying required to pay back 1/15 of that money, so that you don't get taxed on that amount. And then the next year, the 1/15. So it's not a big burden on you going forward, even paying it back. They've made it so easy. I mean, $30,000, $40,000, $50,000, and you've got break that into 15 components, and that's the tax-free portion for that year, right? So,
And especially when you factor in time value of money, when you're making that repayment 15 years later, especially if inflation stays anything near what it is right now,
yeah,
it's going to be a relatively much smaller payment than when you took it out. Because, if you think about it, like if you bought something, say in 15 years ago today, so like in the early 2000s, if you had $20, you could buy a lot more with that $20 than you can buy with that $20 today. So,
right.
but you're not paying interest on it because it's a loan to yourself, right?
Yeah,
So
yeah,
it's an interest-free loan to yourself that you're going to repay. So the payments at the end, once you factor in the time value of money, which I'm not going to get into, how to do all those calculations
right,
now.
right.
But yeah, that's going to be significantly less. So if you've got the opportunity, then I highly recommend that you start making RSP contributions. And you can actually, the deadline for the RSP contribution is I believe it's actually the first day of March, but February 28th would be a good day to shoot for. You don't want to,
We got 2 weeks to the day.
exactly, you don't want to wait till the last minute to do it,
Yeah,
because it gets really busy.
yeah,
Uh,
yeah.
but even if you don't know what you want to put the money into, like if you're buying a home imminently, then I would suggest simply just putting it into like a high interest savings account, because you don't want to worry about the stock market tanking like 25-30% and taking your down payment with it if you're
Yeah.
buying shortly. But if you're buying, in 5-10 years, then certainly, we can look at different investment options that will hopefully give you a much better yield than interest will. But depending on
And,
the risk tolerance and so forth. But
and also, for those that don't know, you can pull out your last year's NOA, and it will show you the contributions that you can make to your RSP based on the previous years that you have not paid into it as well. So
That's a very good point. I should have mentioned that because, of course, you don't want to over contribute to your RSP, or you will
right.
end up facing penalties, and
Yeah.
you're just not a place you want to go. So
Yeah. So there is a limit, and you'll see it on your NOA, and so that's a good place to start. And of course, to give Rick a call and take it from there, so that we can get you saving for your retirement and also a down payment for your home, and so we can get you set up really sweet.
great. So I think
Thanks,
that
Rick.
covers most of the major points I wanted to go over.
Yeah.
But I'm just going to mention that if you like this content, then please like and subscribe below. We've got lots more great content, and we're going to keep putting more out there. So yeah, make sure
Yeah,
to
make sure you subscribe, and Symphony may even come by again later and say hi, but for now she's going. Thanks, Rick. Have a nice day, my friend.
thanks, you too, Sharon.
Okay.